Hello and welcome to Erik Bank. My name is Jonas, Thulin. I'm the head of asset management. Now we try to, as briefly as possible, explain and derive our house view that we're working on. We are, as you might know, a very quantitative, heavily econometric house where we quantify and derive all the position or our opinions. These are our overall strategy and forecast, where we think that our call of Fed hawkishness, peak hawkishness, peak yields and peak inflation is already playing out. I would even argue this week that we have already seen Fed hawkishness. There's not much more to wait for unless you have missed the equity bounce, then you have some work to do if you want to be a bit challenging. We are fortunate enough to be ranked #1 in the whisper number on US GDP growth. We thought we had a good grip on this, so ahead of the number we actually tilted our portfolios even more towards our macro calls, i.e. more growth equities, which is quite exciting that it's so far working out quite neatly. In terms of forecasts and in terms of our bullish view on Q3 earnings reports, we think those are materializing as well. Obviously, greatly helped by the very negative sentiment amongst the consensus. But we believe that Q3 will beat, and so far they are. I have a small graph here, which we show a global index in terms of how the sales and earnings are surprising on the upside or downside. And as you can see, we have a blow up on the upside. About a third it has reported so far. In terms of the US, you have the strongest earnings growth since Q4 2021. So obviously, this is quite neat if you're long equities. Now, the profits are obviously quite bad, but we already knew that. We already priced in a severe recession in terms of equities. So the bounce effect, that's what we're looking for here. We still overweight the global equities. We focused on rebound in Q4, and we still do. We're quite happy to get some traction on that call. We're still in position for a weak SEK. We are happy that our global equities troughed back in June. So anything we get now in Q4 is even more positive, of course. We see a recession in Europe, but still growing global economy. So this blockification idea is still very valid for us. We have bought US treasuries. We have taken profit in commodities, and we're actually leaving more trend-following alternative strategies because we believe that the trends that were quite easy to make money on this year in terms of yields and FX will become a bit more choppy. And then we will trust our own macro more than this traditional CTA strategies, so to speak. This is our house view a bit more in detail. We still believe that we are in a very tactical asset allocation heavy year in that sense. So tactical is a lot more important than strategic because obviously, as you all know, equities and rates have performed equally bad. You have to choose which one do you think you can have a better performance in. We have chosen equities, and we think that being very tactical there is still the name of the game. This has been our strategy and is still our strategy. In the week ahead, the US will hike with 75 basis points. The labor market will slow. ISM will fall back, but far from recession levels as already priced by equities. Very important to remember. Europe is heading for recession. I would argue with the order there. Germany is spearpointing this. This has been our strategy. Hence, we have no equity allocation to Eurozone whatsoever. The hot strategies that we have implemented are soft landing in the US, energy crisis. We are estimating the Republicans will re-enter to power in terms of the Congress. Actually, both the House of Representatives and the Senate. And we believe that CPI is firmly peaked. That is set in stone pretty much. We are sticking our heads out a bit in terms of Fed peak hawkishness. We have the Fed meeting next week, but we agree with the market that the peak hawkishness is actually behind us. So if we're right, we're just going to be able to sit on our books and enjoy the equity market. If we're wrong, then we still have a good, nice little cushion from the rebound in Q4. If you missed this, obviously you haven't caught the great upside that Q4 has delivered so far. We believe that the whole pivot is quite important, and macro is the current driver behind the markets. Now, we have a number of indicators here on the right-hand side, which all support the equity side. So for us, the equity rebound and equity strength is no surprise. This has been a very well and matured and developed sentiment and flows, etc., in the equity market. I will show you a few examples on this. We have never seen this talk of recession in the US for 2022. We just still don't understand where that came from, what we do in terms of 2 negative quarters, but we never bought into it. quite on the opposite. We came out with quite bullish call for the third quarter. We ranked number one, so we think we have a good grip on where the economy is going, and that's where we place our bets on, basically. Global trade, strong, growing, accelerating. Global liquidity, strong, growing, accelerating. Eurozone liquidity, deteriorating, imploding, so you have to choose wisely, we would argue. And again, we are outperforming our global benchmarks, and our call since June holds, which are obviously great position to move into the fourth quarter with. But we'll see how long it would take us, basically, because obviously we're still struggling with being down in the books for this year. This is the same graph that I showed you with the last week. This unique year where both yields and equities perform equally bad, and hence why you have to be tactically very active. It shows where you want to be tactically active, i.e. rates or equities in this instance. As you might be aware, we have chosen equities. This is our performance versus our benchmarks. You have a bit more information in terms of what the benchmarks are, in terms of weights, etc., etc. But obviously, this year we have been able to stretch our legs a bit in terms of compared to our benchmarks. And here you have more details, and that comes down to our tactical work, basically. There you have a pencil low risk versus an index and peers, and then you have pencil medium risk versus an index and peers, and global equities versus an index, global sustainable equities versus index, rates versus index, and sustainable rates versus index. And you can see it from this year or from 2018 and the year, the average return, etc. So obviously we are still struggling this year, as you can see. We're beating indexes, which are sort of it's good, but obviously it's still a tough year in that sense. And as you can see, these are not all the building blocks we're managing, but we sort of limit the table to include only those that we manage more than 500 million SEK in. Global equities still performing quite well, not a new low, i.e. global benchmarks are doing new lows or did new lows. We were fortunate to avoid that. This is a bit more detailed. What has changed on this page since last week? Well, we've actually been more up than last week, which is good fun. But it also shifted away from dollars into more euros, which is we sort of try to follow the spot development here, basically. In terms of the data that come out this week, obviously the US is in a good stride now in terms of the data surprises. But you have non-farm payrolls. We think we pencil in 175,000. I think it's a bit tricky now, given the problems I have with the equations and calculations, given the pandemic and the effects that are still sort of filtering through the math, and I have decided not to take it away, but I'm trying to work to see what can actually make sense. So I'm using a bit more on job postings data. So we think it's going to be a slower or lower number than we saw last month, but not a shock in any sense. And if anything, this goes back to our pivot and peak hawkishness call that we have. Unemployment rate will probably bounce up a bit as well, which sort of makes sense in that world. Notably, if you go into the unemployment rate, you can see in terms of ethnicity and the degree of education, the variables that would trigger a Fed halt. If you listen to Powell and Yellen before, they sort of threw that out of the door in terms of the CPI increase. There are reactions now, political reactions on top of this that I'll come back to, but this will definitely affect the Fed going forward, I think. It is one of the reasons for the peak hawkishness. ISM will come in a bit lower. No major surprise in terms of what we actually can see in terms of traffic in ports, airports, railroads, and roads. But obviously, given that the equity markets already priced in a total collapse, this will be relative net better. So this is a too bearish call or too bearish price that we try to exploit on the upside. Now, this is a fun little whirlwind. It's not that fun if you think about what the actual message is, but it actually tells us that in terms of these variables, there's not much positive momentum remaining in Europe. So hence, we are in a contraction already, is our call. Easy way to treat this is that to be short Swedish krona, to be very careful on the fixed income side, but also obviously have no Eurozone equities in the portfolios. Now, this is what we've been afraid of, and we've been estimating will happen in terms of the 90% probability risk for a German recession, is that we start to see this kind of very nervous flimmers or flickers start to move up on the downside. This is no surprise. We already had a 90% probability of German recession. Our case here is just to don't have equities in Germany, basically. In terms of hot strategies that I mentioned in the very beginning, yes, we're still in a soft landing. Depending on the yields and labor market data, this will move. We have to see where it goes. But so far, we're in the soft landing camp, and that's what we're going to stick to until we're in the hard landing camp. In terms of the winter coming and the energy crisis, we see that, yes, you're going to have skyrocketing prices in terms of electricity. No news there. We keep zero exposure to Eurozone strategies as it is. Now, obviously, media is still a lot more bearish than markets. There are no news here really either. So that which as a trend that, yes, will continue. Where we have seen a bit of new data coming through is on the US political risk and conflict. And this is inverted, but it's actually increasing, which sort of makes sense given that we have the midterms up ahead of us. So what have we done? Well, basically, when we look at the opinion polls and the betting sites, the FX market and the equity market and different, how opinion polls are moving, that yes, Republicans will take the House of Representatives, and oops, all of a sudden, late October, it looks like they will take the Senate as well. We have shifted a few of our equity holdings in the US. In order to front run the Republican win and what that will mean in terms of where they were going to target with their subsidies and money, basically, and tax laws and everything, and environmental laws. So we try to front run this. On the broader picture, we haven't had to do too much, given the fact that some of the laws that Biden has passed will be irreversible, or they are irreversible. So I think that we have to tread a bit carefully there, but we certainly acted on it for the time being. And we shouldn't forget that having a mixed layers of politics in terms of a Republican House, Senate or Congress even, and a Democratic president is quite beneficial for the equity market to begin with, given the historic idea of cross-the-aisle policies. If that's going to work this time around, who knows? Might not, but we have to keep that door open. In terms of inflation, this is a almost boring old slide. Yes, price inflation peaked back in March. There's no new news around that, really. We believe now also that the owner's equivalent rent, this big scary thing that pushes up CPI, will peak, even that the house prices are finally rolling over. We're not too nervous about a housing collapse in the US. But we can see that given the rates and given the house prices, it has to come down. And this will sort of push down the inflation, which is already limited and pushed down by the fact that supply bottlenecks are completely gone from the economy, which is positive. You can see that in port data and shipments data all across the world. Now, quite interesting, if you look at a number of different variables, you can actually see more and more bluish, i.e. the CPI push or trend peaked back in March, which is when the fixed income market peaked, and then it becomes slower and slower and slower, and now we sort of expect the equity market to track to this, which they always do, or we always do, but with a little bit of a time delay, which is why we've been trying to front run the Fed hawkishness and pivot by making these moves made back in June. And we are fortunate enough that they are holding. So that means that now they can start to see that this actually looks quite correct. We can sort of be fairly relaxed in our portfolios. In terms of wage pressure, yes, they have peaked and coming in lower. Pricing plans are obviously rolling over as well. And it's quite interesting that if you compare pricing plans with compensation plans, you can actually see that the pricing plans never really materialized in wage plans, which is sort of quite interesting in terms of second and third derivatives or pressure in the CPI numbers. This is quite important, we think, and quite keen to follow, because that makes the CPI a little bit more hollow than what is commonly argued. Now, consumers expect CPIs to come back down quite quickly, and also the same with break-even curves. There's been a case since summer when we put in our last cash and we threw out our last hedges for the equity market, and we were fortunate enough that trough for us on the global equity side holds back in June, which means that now we can start to really time in what we think now is the past Fed hawkishness, we can sort of hopefully enjoy a strong end of the year. That's been our course, and it's quite obviously a lot more fun to speak of that today, given the strong October. A lot less fun if you go back a couple of weeks. So this will probably shift back and forth, but we think that Q4 will still be quite strong. One of the reasons behind that is that Fed peak hawkishness has passed, in our view. It has passed in the sense that we can see in terms of market probability, they were pricing away 75 basis points instead looking at a 50 basis points hike in December. And if you go throughout the next couple of meetings, looking beyond the 14th of December and looking at 1st of February, 15th of March, and etc., you can actually see this is sort of twisting and turning and pivoting onto the left-hand side, i.e. lower and lower priced hikes from the Fed. And it's quite interesting because obviously if you look at these more sensitive rate curve spots, if you can call it that, if you look at the 2-year forward on the 1 year or the 5-year forward and 5 year, you can actually see that the rate market is really pushing now in terms of Fed peak hawkishness. And to be perfectly honest here, this has passed already. So either you were on this and you had this in your books, or you're trying now to catch up, which we think is quite interesting because we're already max long. If people are starting to be a bit more stressed on this and they have to buy in because they can't afford to miss the year-end rally, because on a relative basis versus competitors or your index, it might look even more daunting because we're all down on a year like this. So I think there will be some forced buying here that could be quite interesting to us that are already long. So we're fortunate enough not to have to chase the fact that the Fed peak hawkishness has already occurred. Now this can probably go back and forth a few times, so we're fully prepared for that, but we're going to stick to that for the time being. In terms of QT, quantitative tightening, we can't really see any financial pressure from that in the banking system, so this is going on smoothly. We're not repeating 2018, 2019. I explain here a bit in the text, so there's nothing really new to talk about that. Now this whole idea of Fed hawkishness has obviously then been front-run by the Fed themselves. Now, they do a great work with calculating their own written material and speeches through a process called natural language processing, which they then distribute to the market. So we can already see that, yes, they have pushed into, they already made the pivot and pushed into more dovish speaking, and you can see the gap between the 10-year yield and the actual dovishness. So obviously we have bought the US Treasury here, trying to anticipate a rollover in yield terms. And obviously that also kills a lot of the CTA strategies out there, so you have to be nimble here and take away those positions as well. One of the facts that I mentioned the labor market before is that these labor market indicators that has dictated Fed previous past before this inflation shock is indicating that you shouldn't hike that much more. And I put in here a little headline that came on Bloomberg today, that you already have the banking committee arguing that the Fed has to slow down and look at the labor market, which we think is quite interesting. Political pressure that starts to build on the Fed, as we can already see in Europe, not so much in Sweden, I would argue, perhaps too little in Sweden, but definitely more in Europe. So, a long story short, we have bought the US Treasuries. We think with this underlying model will be proven right, i.e. yields will start to come in lower. Hence, good time to be long growth. The swap spreads are showing the same thing as well in terms of yields. And this whole pivot, I explained this last week, but basically we look at the Fed rate versus a restrictive rate, and we make that cyclically adjusted towards the output gap. And then we allow the calculations to be open for negative term premia. And then we put it all against the equity market. You can see a huge rebound in the equity market. We don't think that will materialize to that extent, but I think this is sort of, again, as I argued last week, why the market is obsessed with the pivot, because we all understand if we start to make a break for this in Q4, this could be quite an interesting rally. And we have to remember that the rally in Q4 is already extraordinarily strong, looking at history. Now, the rate hikes have obviously tightened financial conditions in the US. We have a plummeting financial conditions in Eurozone, so we don't invest there. US flat, stable trend, severe but stable trend, so we can handle that. And the reason why US can handle that is because companies, banks, financial instruments, we can't really see the stress building up anywhere in Europe. Obviously, as I showed before, we have a skyrocketing stress in terms of liquidity. On the back on this, I was about to say in the back of the bus, but on the back of this is obviously the fact that the US is a lot less debt in terms of debt ratios. They have a lot of stimulus checks already in bank deposits, etc. So this is a completely different ball game. And also don't forget that fact that if rates pop up in the US as they have, the biggest sectors you should avoid with a positive beta towards this is obviously Europe. So we have been long Chinese equities. We have taken off that. Our bet was that liquidity will be the name of the game for Chinese equities. We were obviously discouraged, or if that's a word, or by the Communist Party's 5-year planning meeting, which didn't go as we had hoped, in the sense that just get a confirmation to trade liquidity. So we decided to try to be prudent and take away a lot of that position and put it back into US growth. Why the US? Well, because we can see a positive development in the daily trading indicator, daily range in terms of flows. We can see margin depth rebounding. We can see sentiment rebounding, and observe now the sentiment turned around a lot sooner than the equity market. So there are pockets of wealth here already happening in the equity market going back to late September, which we think is quite interesting. If you look at our risk indicator, you can also see that we start to move upwards. And if you look at highs, lows, advanced declines, bullish, bearish, you can also see a strong upside potential for the equity market. And this is really the name of the game. In terms of any equity model that we look at, is all indicating upside on the equity side. The sell pressure was exhausted with this magical level, as it usually is. And on the right-hand side, I show you the fourth quarter move on the equity market in the US. With standard deviations, and we are where we are today. So given the historical relationship or the historical pattern, to make 7.5% in US equities in the month of October is rare. It is super strong. And either you had that in your book or you missed it. We think there were plenty of reasons to start a position for this back in June. And we're quite happy with all these indicators sort of making this work for us, and we were able to avoid new lows given the more challenging environment we had back in August and September-ish, especially September. Our data range indicators are also quite bullish, and funnily or fortunately enough, we're getting flows now in our bags, which is just sort of pushes us forward, which is really good and really interesting and good fun. And also the option market is starting to position for more upside. So that's also quite interesting. And also when we predict gamma exposure, we can also see that we think the future gamma exposure will be on the upside. So it's quite of underlying positive events happening now in the equity market. Now, if you look at the bear market probability, it's actually negative, so we can't really see a bear market probability. And as I said before, when we took off China, we built in more growth in the US ahead of the US GDP number, trying to make all this work and make sense of it. One reason is this indicator that we can see that growth has been a little bit beaten up versus value. And given our underlying indicator, we are betting on our indicator. We're not following the relative momentum between different sectors. As such, we bought more growth. We will see if that works. That's our position. And so far, at least, we're beating our index on those calls as well. On the back of this, why equities in the first place is the fact that earnings revisions troughed about 4 months ago. This is old data, but it's funny how little it is discussed actually, that you can actually see less and less downward revisions now on the corporate side, globally, I would argue. So obviously, global equities, global GDP models are turning around as well on top of this earnings revision. So it's it sort of makes sense really. The reason why we were bullish towards the year end, the last 2 quarters, is this model here, which we call the golden hook back in the summer, where we look at earnings revisions, price target revisions, and economic surprises. And we still see positive momentum, a bit less than we saw before, but obviously this is a quite nitty-gritty, try to time the exact basis points or the points move on the index. But at least we're in a positive territory, so this conclusion from this stands in terms of further upside on the equity market. Now, the GDP models, as I mentioned, we were fortunate enough and humble enough to say that yes, we were number one in predicting US GDP growth, but we tried to front run that. If that was going to work, now we have to work with the Q4. So we'll see what happens on that one. But we can't really complain about the relative performance that we're having for the time being. Given the last US GDP data that came this week, back on Thursday, you're actually still in deep and expansionary territory. There's not much more to say about this, really. The whole recession discussion is for someone else. It's not our house that argues for that. Now, costing models in the US is obviously outperforming Europe. Short-term indicators, yes, we see a slowdown, but we don't see a recession. This is a recession indicator. Yes, 25% recession risk on this way of calculating things. If you look at Feds, when they calculate from the credit side, they came up with a 24% recession probability for the next 12 months. We want to stick our necks out for the next 3 quarters because we actually get some new work. They're working on towards the end of 2023. It looks a bit more negative than this. For the time being, though, global macro has troughed and peaked. Has troughed, might have peaked, but probably not yet. And this is quite important to remember because it's quite often forgotten, especially if you're European or if you're a Swede, in the sense that we're quite depressed for good reasons. We're just starting our recession. That's not to be confused with the fact that the global economy is reaccelerating. It's tough for Swedish companies, etc. But it is what it is, really. We don't really have to talk about US or Swedish GDP models. They are sort of still hanging on to those core views. In terms of SAM rules in the US, no, you don't see a recession. In terms of more advanced business confidences, no, you can't see a recession. If you look at the data that usually actually define a US recession, you can't see a recession either. You can actually see more improvement. So for the time being, we're going to stick to our guns in terms of positive US growth. That's where we're going to allocate our capital. In terms of global trade, nothing new here really from the last week. We still see freight activity chopping on. We still see a lot of good trades between China and US, and globally strong global growth. In terms of liquidity, we can actually see a rebounding and positive global credit impulse indicator. This is hugely important because this really leaves Europe way back in the dust. So this is quite important now to have the right mixture, I would argue, on the global side more than anything else, or at least use currency exposures as overlays on your top of your equity exposures. Now, obviously, you have a huge rally in credit impulse indicator in the US. It sort of makes sense to hike rates in the US. A lot less sense from this perspective to hike in Europe. This is all secondary to CPI, of course. And don't forget the share buyback story that we pushed a couple of weeks ago, that the US companies are abundant in cash. We know the share buyback taxation will start 1st of 1st. So there might be a window now for increased share buybacks. And there are some written articles on Bloomberg about how huge the share buyback momentum is. It might actually already be here. We don't have data on it yet. We can only hear news stories. But it's certainly, definitely something that you should need to add to your book if you haven't, I think. So our strategy is to focus on tactical, as I mentioned. We're looking forward to the week ahead, where we see 75 basis points from the Fed. And we see, obviously, a European recession and so forth, but not much more than apart from Europe. We have implemented a lot of strategies in our books: soft landing, energy crisis, Fed peak hawkishness as behind us, Fed pivot, etc., etc. And there are an abundance of indicators that support the equity market. It really demonstrates that the equity market has been well prepared for this pivot and are really trying to benefit from it towards year end. In terms of macro, we think we have a firm grip on it, given our competitiveness that for the time being. So that will obviously change. But here now we sort of tilt the portfolio towards more growth, trying to really make some money on this. So we'll see if that works. Don't forget, global trade and global liquidity is accelerating, quite opposite from Europe. This has also been part of our strategy. So we continue to outperform our global benchmarks, and our trough call from June holds. But we're quite humble that we're probably going to flip-flop, and it's going to be in the market flip-flop in sense of this pivot and the Fed hawkishness. But we're going to remain firmly positioned the way that I explained here for the time being until we see some proper data change the potential call from us. There are some forecasts here towards the end of the presentation, but otherwise you find all our material where they usually are published. So I thank you so much for your attention, and I will see you next week.